Hi, I'm James Robinson, and this is my stock thought of the week. What we're going to look at this week is the statistic of shares outstanding, and that's just how many shares are available in the market to be purchased. We're going to talk about why an investor would look at that. Its value both as a financial tool and for me as a diagnostic tool. We're going to talk about what is shares outstanding. We're going to talk about share repurchases, the pros and the cons. We're going to talk about share issuances and what we should think about that as an investor. We're talking about what we can learn from the shares outstanding, as well as thoughts on accounting for shares outstanding. So in terms of shares outstanding, when a company sells itself to the public, that's called going public or doing a public offering. What they're really selling is little tiny pieces of the company, and we call those stocks or shares. And what that effectively is little ownership pieces of the company. So somebody owns a company and they want to sell it to the marketplace, which means to everybody. So they break it up into all these millions or billions of little pieces, and they allow the shareholders to buy a piece of it. Every company will decide how many shares they're going to sell. They're going to decide at what price they're going to sell those shares. And when you add up the total price for each share times the total number of shares, and that's the market capitalization of the company. So if the company owner thinks their company is worth $100 million, they may sell 5 million shares at $20 a share, and that's how you get to $100 million. And thus, when they sell all those shares, the seller has gotten $100 million, and the buyer has gotten their tiny little piece that we call a stock certificate. Over time, the company can issue more shares for various reasons. They can sell shares to raise additional capital, to pay down debt, to finance a merger or acquisition, to reward executives or employees, or just to increase the cash on hand. When this happens, the original shareholders are diluted. So if, let's say that a company has 5 million shares and they sell another million shares, well, now they've got 6 million shares outstanding, and for every share you used to own, you now own 80% as much of the company. But that is deemed to be okay because you've gotten a bunch of money in exchange for selling those million shares, which offsets your dilution. At least that's the theory from an accounting perspective. Ultimately, the management might use additional cash to buy back shares. In those cases, the company uses its cash, reduces its cash, they pay them out to the market, and they buy back the shares. The benefit of that is the shareholders that are left is they own a larger percentage of the company, and the negative is that the company has less cash on hand because they've expended that cash to buy back shares. As a change in the number of shares means of change in the value of each share, it behooves the intelligent investor to have a sense for what's happening with the share count over the medium and long term. So what I mean by that is if the company's issuing shares over time and they do that relatively consistently, that means that the guy who bought maybe 1% of the company today will own 0.5% of the company years later. And if the company's not increasing earnings faster than they're issuing shares, then you're being diluted, your buying power is being diluted, and your investment is being degraded. And obviously the opposite is also the case. If the company's buying back shares, then you're effectively getting free additional ownership stakes in the company. And so you want to, as an investor, have a sense of that. I don't think many people take the time to look at that and analyze that. But I think if they did, they'd have a better sense for what's happening to the company long term. So here in this slide, we just simply look at what's happening. So the total earnings for a company is $60 million. There are 15 million shares outstanding. This is just for a hypothetical company. The earnings per share then are $4 per share, right? $60 million in earnings divided by 15 million shares is $4 per share. If the company trades at a PE ratio of 10, that means the share price would be $40. That's $4 of earnings times a $10 PE ratio is $40 per share. And that would put the market cap of the company at $60 million. That's the share price of $40 times the 15 million shares equals a market cap for the company of $600 million. That's just a fundamental look at the way a company is valued and the way that the interaction exists between the earnings, the shares, the earnings per share, the PE ratio, and the share price. That's just sort of the fundamental thing of the way these things work in relationship to each other. So now let's look at a situation where a company buys back some shares. So let's say that the company has earnings, we're going to really oversimplify things here, but let's say the company has earnings of $60 million. The The company has 15 million shares outstanding. That earning works out to $4 per share. The PE ratio is 10. That's a $40 share price. The market cap is $600 million. But let's say that company uses its entire earnings, all $60 million, and uses those earnings to buy back shares. So let's look at what would then happen. So they take their $600 million, they buy back, that would allow them to buy back 10% of the company. They buy back 10% of the company is 1.5 million shares. So now the company doesn't have 15 million shares outstanding anymore. It has 13,500,000 shares outstanding. The same $60 million in earnings divided by 13,500 shares is $4.44 worth of earnings. You look at that at a P ratio of 10, that's $44.44 per share. You take $44.44 per share times 13.5 million shares, and the market cap is still $600 million. So you see what's happened here is the company has reduced the number of shares outstanding. The company still is worth exactly what it was worth before. It's just that there's fewer shareholders sharing that worth. And so their value of their shares has gone from $40 per share to $44.44 per share. And that's kind of a fundamental look at the way share buybacks work and the way they enrich shareholders. The guys who sold their shares no longer are owners in the company, but they don't care because they got their money back. But the people who own the company in the future are going to be enriched because they're sharing the profits of that company with a fewer number of people. But it is the same amount of money that's being shared. There's an additional benefit to the existing shareholders of a share buyback. You have total earnings in this scenario of $60 million. You have shares of 15 million in the first analysis. The dividends, let's say you're going to give away 50% of your profits. Instead of buying back shares, you're going to give 50% of your profits to the shareholders in the form of a dividend. So you have $30 million spread out over 15 million shares, means you have $2 per share in dividend. The $2 per share in dividend equals 5% yield because the stock price is still $40. Now let's change the numbers. Let's say the company has bought back the year before 10% of the company. So now there's not 15 million shares outstanding. There's 13,500,000 shares outstanding. So you have the same earnings, $60 million. You're dividing those earnings by 13. You're dividing the $30 million that you're going to spend on dividends, which is still 50% of the earnings. You're dividing that by 13,500 shares, 13,500,000 shares, which means your dividend is now $2.22. So the dividend's gone up by just over 10%. The stock price is still going to be 44.44 because there's fewer shares. And then that means the yield would be constant. So what's happened is from year one to year two, your stock price has gone up and your dividend yield has gone up, even though the earnings have stayed the same. So now that we have a sense of what's happening with share buybacks and how that affects both your equity stake in the company and potentially your dividends going forward, let's talk about why else share buybacks matter and why we as investors should be looking at them. So in theory, the issuance or repurchase of shares should be a non-event from a financial or investment perspective. The reason for that is each is either received or exchanged for a commensurate amount of equity in the company. So the book should balance, right? If we're buying back 10% of the company, but we're using enough cash to justify buying back 10% of the company as defined by the market, then why should we care? And that is, from an accounting perspective, the way it's supposed to work, but from an investing perspective, it's not the way it actually does work. Markets are dynamic. The stock price is very rarely exactly commensurate with the value of the stock. Oftentimes the stock is slightly higher than the value of the company. Occasionally the stock is slightly lower than the value of the company. There's a whole bunch of reasons for why that might be, but the odds are almost 100% that you're not going to buy back shares or issue shares on the exact date that those two numbers balance. So as a result, management may pay too much to buy back shares, or they may undercharge for the shares that they're selling to the public. In both of those cases, existing shareholders are damaged by the transaction. So let's just use round numbers. Let's say that the company is worth $100 a share. That's what the intrinsic value of the company is. But let's say today the market says the shares are worth $90. Well, if my management issues stock in the company at $90, then I'm really only getting 90 cents of value for every dollar of stock that we sell. That's bad for me, the shareholder. And the flip side is also the case. If the stock is worth $1 or worth $100 and we have to pay 110 in the open market to buy back those shares, and the management does it anyways, then I, as the shareholder, am getting damaged. So the first thing we want to look at when we're looking at buying shares or selling shares is what are we doing in relation to the intrinsic value of the stock? And one of the real problems with that is I would argue most managers aren't very financially savvy in terms of investors. They're great at running a business, but they probably aren't great at valuing the business. And the result is there's an opportunity for the shareholder to get damaged at either the issuance or selling of stock. We would love to have managers who will time the share purchases and issuances intelligently. And if we had that, that would be wonderful. If they only bought when the stock was undervalued, that would be great. If they only sold when the stock was overvalued, that would be great. But one of the problems is we can seldom determine at the time of the action whether it was a good time or not. Usually it takes some time to figure out if the price that we paid was the right price. The other thing to keep in mind is that management tends to overinflate their own abilities. Management will never tell you they don't know the value of the company. Management will never tell you that they mistimed that transaction. And once they do that transaction, they're certainly not going to complain and tell you that they screwed up, or at least very few of them are. They're going to obfuscate and pretend that it didn't happen and come up with reasons to justify their position, or just never mention it at all. And so one of the real problems with the issuance of stock particularly, but also the purchasing of stock, is that oftentimes these things aren't timed as well as they could be. What you're going to see later is that the fact that the timing can be so poor in purchasing or repurchasing or issuing of shares, that alone can take what would have otherwise been a good investment into a bad one, or vice versa. So we do want to be looking at what's happening with the share count, and we do want to be trying to get an understanding of how intelligently those decisions are being made. So now let's talk about the pros of a stock repurchase from the standpoint of an investor. When a company has profits, they have 5 things that they can do with those profits. They can pay a dividend, that's a check written directly to the shareholders. They can buy back stock, which is an indirect benefit to enrich the shareholders. They can pay down debt. This increases the balance sheet of the company. It reduces the interest obligations of the company, and thus should have a positive effect on earnings. They can accumulate cash, which again helps the balance sheet, potentially creates interest income, and also makes the company stronger should an event occur for which they can use the cash. And finally, they can reinvest or retain those earnings. They can retain or reinvest those earnings in the business, whether through buying subsidiaries, or mergers, or new plants, new factories for research and development, whatever the company might need cash for to help the business grow. So the decision of what to do with that excess cash is called capital allocation. And we're going to talk a lot about capital allocation as we go forward. But really, capital allocation just basically means what is the management doing with the profits, and are they making intelligent decisions which are going to maximize the benefit to the owners of the company. There are arguments for and against every one of those options, and many of those options have to do with the timing of the situation. If the stock is grossly overpriced, we probably shouldn't be buying back shares. If interest rates are very, very low for the debt that we have, maybe we shouldn't pay down debt. Maybe we should retain it and invest in the business. If there's great opportunities to go buy some merge with somebody or acquire some business, then obviously maybe that's the right thing to do with the money. So there's a time and a place for all 5 of those options, and most businesses do some combination of them. But that's one of the key jobs of management, is how do we allocate that capital? So buying back shares for management and for shareholders has several advantages. It's a tax-free transaction to the shareholder. The value of my holdings goes up because I own a larger percentage of the company, but I didn't get any cash or direct benefit from the owner. And as a result, I don't have a tax consequence until such time as I sell my stock. And so that tax deferred or tax invisible situation for a stock buyback is really one of the major advantages. it also means that the stock, because you're doing the stock buyback, in addition to being tax-free, it is expected that the stock will increase commensurate with the amount of the percentage of shares that are bought back. It also means that the dividend income is spread over fewer shareholders, and thus there's an expectation that dividends will be increased. At the very least, dividends will be very easy to maintain in the event of a downturn of the business, because again, they're just not having to pay as many people the same amount of money per share in dividends. Finally, since many times employees, and especially management, are at least in part compensated by stock options, the fact that we're buying back shares increases the value of the stock underlying those options and tends to enrich the stock option holders, which further incentivizes and rewards employees and management. So you add all that up, and those are the reasons why a management is likely to choose repurchasing shares when it's time to allocate the capital. So now let's talk about the cons of why management shouldn't or ought not to or won't do share repurchases. So the first reason that I, as an investor, don't want to see or want to look closely at stock buybacks is they can be used to artificially improve results. Oftentimes we look at a company and we value it not based on the total amount of earnings, but we look at the total amount of earnings per share. So it's possible to have flat earnings or even slightly decreasing earnings, but you buy back enough shares that the earnings per share will increase, even though there's been no improvement in operations. So the company, let's just say, makes $1 million, or makes $10 million year one, and it makes $10 million year two. But between year one and year two, they bought back 10% of the shares, then the earnings per share will increase by 10%, even though the earnings themselves were flat. This tends to make management look like it's doing a better job than it is. And that's something that we want to keep track of as we're investors looking at what they're doing with the capital allocation. This also means that the buying back of shares can tend to mask the fact that a company is in fact stagnating. It's not really doing much, but it looks like it's getting better every year. And in fact, effectively what's happening is the management is using the shareholders' money to buy back stock and make themselves look like they're doing a better job than they are. So obviously you can imagine why we'd want to avoid that. Another thing is the propensity to overpay for shares or buy shares without value, without regard for the wealth they're creating the shareholders. This is a system where you got to imagine that you're the manager of a company and you think you're pretty smart and you think that you're going to make more money every year. And so regardless of what the stock price is, you believe you're going to do better next year. And if you believe that, then why shouldn't you buy back the shares? It's not necessarily that the management is evil or that they're unintelligent. We're selecting managers because they're very confident. And you don't become the CEO of a big company without being extremely strong-willed in your beliefs and extremely determined that you can do anything. So that, while that might make you a great manager, it doesn't make you a great allocator of capital. So we want to be careful that we're not buying back shares at too high a price. That's, by the way, one of the reasons why I don't think you should own companies forever. If you own a stock, there will be a period of time when that stock gets really overvalued. And if you own a stock and it's really overvalued, you have the risk that it can settle back to the market. But you also have a risk that your management's buying back shares in that situation and wasting your money. So we want to keep an eye on that. Another thing, if management compensation is based on earnings per share, then it creates unjust compensation, bonuses, and raises for management. So again, we talk about that scenario where we have $10 million of earnings, and the next year we have $10 million of earnings. That management's not entitled to a raise or a bigger bonus in that scenario. But if the management has structured their compensation such that they're measured by earnings per share and they buy back 10% of the shares, well, then they're going to correctly say, hey, our earnings went up by 10% per share. I want my bonus. I want my additional stock options. And so the fact that that is a possibility is something that needs to be watched out for. And whenever you have an unfair or imbalanced objective or incentive, then you're going to find people tend to gravitate towards what's in their best interest, even if it's not in the best interest of the company. Another thing is that the stock price should settle where it settles based on the demand for the stock. But when one of the people buying the stock, and oftentimes in great volume, is the company itself, then that tends to overshadow the market and it will support a stock that perhaps should be falling, and it will perhaps make a stock go up that should be flat. And that makes it hard for me as the investor to figure out what's really happening with the stock, because there's these hidden incentives going on in the marketplace. Again, we have a disincentive, or we have a divergence of incentives between management and shareholders. When we buy back stock, the shareholders only want you buying back stock when it directly benefits them, which means you're only buying back stock that's undervalued. But the CEO will look at it differently, and what's in his best interest is to buy back stock almost at any price. An additional thing is it can mask the price paid for acquisitions or for employee compensations. So when we're buying a company, and instead of paying cash for the company, we're paying stock for the company, then it may be that the stock we're paying, the value of that stock has been misadjusted as a result of us buying back shares. And or we're end up overpaying for the company because we bought it with cheap shares. The final thing is there's no intuitive way to measure value created versus cost paid for share repurchases until several years have passed. You can't really tell until you look back what really happened, and that's one of the things that makes buying back shares kind of difficult to manage in the short term. So let's look at the long-term effect of share buybacks. This is an extreme example, but it's a real example. It's a real company. There's a company called AutoZone. The symbol is AZO. And AZO went public in 1991. And from 1991 till today, they bought back roughly 90% of their shares. The company has been well managed and well run. Its earnings are up about 11% a year since 1991, which means they've gone up 33 times. That's really pretty good, very good. But because they were buying back shares the entire time they were doing that, the earnings per share have gone up much faster than the earnings. Again, because there's less shares to divide all that money by, the earnings per share have gone up at 18% per year, which means that instead of the earnings per share have gone up 290 times, even though the actual earnings have only gone up 33 times. So that's the power of buying back shares and of doing that over a very long period of time. You see that the value of the company has gone up at 19% a year, and that's almost 470 times. So $1 invested in 1991 is worth $470 today. The company is better than average when it's run, but not spectacular. Again, up 33 times in its ability to generate profits, but its ability to enrich the shareholders is up 489 times. So $1 invested in 1991 is worth $489 today. That's a very, very powerful thing. And again, the thing to keep in mind is you only invested that dollar once, you never put in another penny, and the board and the CEO made you richer every year by virtue of the fact that they were buying back shares. That's capital allocation at its best. So let's look at these numbers a different way without the charts. Let's look at the pure numbers. So looking at the first line, the stock price. In 1991, when the company went public, it traded $7.12 a share. In 2025, adjusted for splits, the stock would now be $3,342. That's 469 times your original investment. The compound annual growth rate would be 19.2%. That's spectacular. The net income over that same time, however, went from about 75 million to about 2.5 billion. So that only went up 33 times. And then a compound annual growth rate of 11%. And then the earnings per share diluted, which remember is taking the 2.4 billion and dividing it by the fact there's so fewer shares because they bought back 90% of the shares in that time frame. It went from about 50 cents per share to $144 per share. And again, this is all adjusted for splits, which is 290 times the original income, and it's a compound annual growth rate of 18%. So again, the idea that you can buy back shares and do it over a very long period of time can create tremendous riches, even if your stock is only slightly above average in terms of its ability to produce income. Another thing that I want to talk about is the issue of share issuance. When companies are issuing shares, so the share count is going up and the shareholders being diluted. By diluted, I mean like not diluted as in tricked, but diluted as in there is less density. So there's two main reasons why a company would be issuing shares. The first one is the company needs outside capital to operate. That means that they're not generating enough earnings to sustain itself. For me, that is almost disqualifying by itself before any further analysis. I like stable companies that are generating cash, that are able to fund their growth going forward. And if it can't fund itself from earnings, it's probably not a company that I want to buy, especially not if I believe that the reason for doing that is because they need the funds. That to me is just enough of a red flag. There's enough other companies that aren't doing that I can just move on to the next company. Some people would say, well, wait a minute, you're missing another reason that they might issue shares. And that's using stock as acquisition territory. So the ideal here is somebody wants to sell their company to you, but instead of getting cash, they want to take equity in your company to do it. Well, there's problems with that. The first thing is, if our stock is currently underpriced, then you're giving away shares to the seller of their company too cheaply. And I don't want my management to do that. I want to get full value for my shares. The second alternative is, okay, well, what if the stock is overpriced? If the stock is overpriced, then surely I shouldn't mind issuing shares to buy another company or to buy another asset. The problem with that is, well, if the company is so overpriced, why do I want to own it in the first place? So it's almost either door leads to the same answer. I don't want to own the stock if they're giving away my shares too cheaply to buy something, or if it's so expensive that it makes sense to give them away to buy something. I'd rather just go find some other stock. Another reason why a company, and this happens all the time, why companies will gradually increase their share count is because they're giving away stock options to their employees. They're calling it incentives. The argument is that stock options align the employee's interest with the shareholders' interests, and therefore, if the stock goes up, everyone wins together, the employees and the shareholders, and that's really great. It therefore incentivizes managers to grow the company. In reality, that's a bullshit argument. The reality is true alignment means that the employees would pay cash for the shares at market price using their own money. That's when they're aligned. When you give them options that cap the downside, the employee doesn't have a downside if the share prices go down because they never buy the stock. And then if the stock goes up, they disproportionately benefit from that increase because they're not buying the stock at a market price, they're buying stock at some market price, at some sub-market price, and therefore getting an additional incentive benefit. So it doesn't create alignment, it creates a one-way asymmetrical bet on behalf and the benefit of the employee. And it also encourages the employee to make short-term decisions because they just want to get the stock as high as they can so that as soon as they get vested so that they can cash out. So, you need to be aware. And the other reason to think about this is that the most sophisticated person in the company is almost certainly the CEO. He's almost certainly more sophisticated than shareholders and than anyone else in the company. And he's fighting for stock options. He's not, by the way, using his millions of dollars of compensation and his bonuses to buy shares on the open market. CEOs almost never do that. What they're doing is doing what's in their best interest, which is not taking the risk and getting the upside if it works and no downside if it doesn't work. And that's not really an alignment. And the analogy that I use, if you're rich and she's pretty and young and she won't sign a prenup, the reasons why she won't sign are financial. They're not romantic. As we've talked about many times, the gold standard for CEOs and for ethical behavior is Warren Buffett. Warren Buffett never took a single stock option in his career. He never paid compensation for any Berkshire employee anywhere. He actually says that in his SEC filings. He said it in his annual meetings. He said it in his annual letter. And so it's not a preference for him. It's not a speech. It's been a rule for 60 years. That Berkshire doesn't do it, and I just have this sense that if Berkshire doesn't do it, no one else should either. Having said that, we do recognize that management, that businesses oftentimes have to give employees compensation in the form of stock options because that's the market, that's what everyone else is doing. And so if you accept that that's the market and that's what everyone else is doing, then management has to do the right thing by the shareholders. And the way that they do that is they should be adjusting the share counts to compensate for shares issued to employees. So this is what the share count actually tells you from my perspective as an investor. If the share count is shrinking, then that means management's buying back shares equal to or greater than those shares issued specifically to employees in this analysis. Hopefully that means that they're paying the real cost of compensation now in cash rather than hiding them. And every remaining share is worth more without us having to do anything, again, because they're shrinking the share count. If the share count is flat, which is not a problem, but it's not a benefit, then they're neutral, at least they are then neutralizing the dilution from stock compensation. They're holding the line. It's an acceptable minimum. The options aren't being deferred onto the shareholders, and we're paying the actual cost of compensation in real time. I don't have a problem with that. But if the share count is rising, then the compensation costs are deferred, and it's deferred silently. So the shareholders really never really think about it, and they don't notice it. That means the business can't or won't fund itself, and the management thinks the stock is overpriced. And finally, the odds argument that I want to make here is so let's think about, as it relates to employee compensation, what the share count is telling us. If the share count is shrinking, then that means management is buying back shares equal to or greater than those issued. That means that they're paying the real cost of that compensation now in cash, and hopefully it means that every remaining share will be worth more without us doing anything. That's great. That's management doing their job. If the share price is flat, that's okay. I don't have a problem with it. At least in that way, they are neutralizing any dilution by whatever shares they're issuing to employees in stock options, they're buying back on the open market. And that means that they are paying the cost of compensation in real time. And it also means that share compensation is not being deferred onto shareholders in the long term. Having said that, if the share count is rising, then that means that management is effectively putting compensation onto the backs of the shareholders, and we don't like that. It means that the business either can't or won't fund paying its employees, and we don't like that. So where I want to go with this, the last point I want to make is that there's a financial analysis that can be done related to shares outstanding, and you can start to tell a lot about what's happening with the business by the shares that's outstanding. More importantly, you can tell how good a job the manager is doing. It's a diagnostic tool for the skills of the manager, or the incentives of the manager, or how well the manager is putting the shareholder first. If the management is buying back shares at a price, let's talk about what the share count actually tells us, especially as it relates to employee compensation. If management is buying back shares faster than they're giving away shares in compensation, then that means that they're paying the real cost of compensation to the employees in real time. It's not being hidden, it's not being put onto the future, it's being paid in real time, and it's being paid in the form of share repurchases. And that means that every remaining share will be worth more without the shareholders doing anything. In that situation, I'm probably okay with stock compensation plans, because at least I know management is being honest with me and is offsetting that and creating value. I'm actually less okay, but still okay, if the share count is flat. That means that the management is neutralizing dilution by buying back shares at the same rate that they're granting them to the employees. That's an acceptable minimum. At least the options aren't being deferred onto shareholders. And it means that we're paying the cost of compensation in real time. But as we've talked about before, there's almost no excuse for a rising share count. And if I see a rising share count and it's just because the employees are being paid, I presume the employees are being paid in a way which is not fully disclosed or fully considered to the benefit of the shareholders. And for me, it's enough of a red flag that I'm probably not going to be interested in looking at that stock as an investment. The next thing that I want to talk about is the diagnostic ability of looking at share count. So there are some accounting and financial information that can be gleaned from looking at share count, and we've kind of discussed that. You can see that, hey, these guys are buying back shares, which means over time you can own a bigger percentage of the company. Hopefully that's going to work out like AutoZone. You can see that the dividends ought to be increasing, and you can over time hopefully figure out if the ownership is at least consistently buying back shares at a fair price versus overpaying for them. And so those are very valuable things. And obviously the flip side of that is also true, right? You can see that the company is, if they're giving away shares, then it's very hard and very unlikely, I say giving away, if they're issuing shares, it's very hard and unlikely that they're doing that for reasons which are going to benefit the shareholders. But in addition to that, there is a diagnostic measurement for the appropriate incentive of the management. If the management is ignoring making good decisions and buying back stock anyways, that's a really big red flag for the job the management is doing. And so that's something you want to keep track of. And we talked about thoughts on accounting. How do we figure out if management is paying a fair price for the shares in the long run? In the short run, we won't know. In the short run, the stock will fluctuate over time. The manager might be doing everything they think is intelligent, and some bad news happens that couldn't be controlled, and it looks like it was stupid, but in real time, it probably wasn't. But in the long term, we can tell if those things are happening. And the way that we can tell is if the company is doing a good job of buying back shares, then the rate of increase in earnings per share should be faster than the rate of the share buybacks. So again, just using round numbers, if you're buying back 10% of the stock, we've already demonstrated you should be getting an automatic increase of 10% in the value of the share price. You should also be getting a value of 10% in the value of the earnings per share, right? Because you have the same earnings divided over a smaller number of shares. So if it is the case that the earnings per share is growing faster than you're buying back stock, then management's probably doing a good job. And the value of the stock that they're buying is appreciating over time, which is what happened with AutoZone. Not every share that AutoZone bought back was bought back at a cheap time, but it was bought back rationally and reasonably enough that over time, as the earnings increased, it made the stock purchases look okay. And so that's really the accounting tool that you want to use is the rate of share buyback equal to or less than the rate of earnings per share increase? And if it is, then this is probably an okay company in terms of its buying back of shares, and the management is probably doing a good job. So that's it for for shares outstanding and what you can learn from it. Thank you very much.